All eyes in the stock market today were on the Fed's chairman, Jerome Powell, and he has the best way to sum up today's Fed meeting.
You can think of this meeting that we had as the talking about meeting, if you like.
He does crack me up, but in this video, I want to talk about some of the highlights from the meeting, how the market reacted, and then how I see this affecting me as a stock investor. In regards to rate hikes, the Fed expects there to be a hike before the end of 2023. Before this meeting, the expectation was until after 2023 we would see some rate hikes. This does change what was said before, but it really comes down to what the data looks like.
I expect that we'll be able to say more about timing as we see more data. Basically, there's not a lot of more light I can shed on that.
One of those data points is the unemployment rate, which is around 6% right now, but the Fed is targeting something closer to under 4%, which is pre-pandemic levels. Another data point that everyone is concerned with is the inflation rate, which in May we saw a 5% increase year over year, but we have to remember that the base level compared against has very low energy prices, and then other things like used cars are running into supply issues. So part of it may be inflation, part of it may be supply side issues when it comes to commodities. That being said, the Fed did increase their inflation expectations to around 3.4% this year versus a previous estimate of 2.4%. With all that being said, Powell isn't backing off on the bond buying program where they're buying around $120 billion worth of bonds every month. So that is continuing to happen until the economic data really shows that they need to back off the bond buying. So how did the markets react to all this? If we take a look at the S&P 500, at the start of the meeting, we had a sell-off with a continued sell-off up until about 245, and then we had a nice little rally going, pushing the markets higher, and then towards the close had a smaller sell-off. But overall, the markets digested the information and there wasn't too much of a reaction other than some choppiness. We did see treasury yields react pretty violently at the beginning of the meeting. We had a spike with the 10-year yield going up around 5%, which is a pretty big move when it comes to treasury yields. Now, this is definitely off the back that maybe we have rates coming higher earlier than expected, so this doesn't surprise me one bit. And with that spike in yields, you saw stocks like JP Morgan or the financials also kind of had a bump up with that yield spike, which is kind of funny because Jamie Dimon, the CEO of JP Morgan, talked about sitting on around $500 billion worth of cash and his fear of buying treasury yields right now because he expects them to go higher with inflation going higher. So it looks like Jamie Dimon is betting on those yields to keep on climbing. If you didn't check it out already, I made a specific video around investing during inflationary times, but we'll cover some of the sectors that I believe will do well if there is higher inflation. One of them being the financial sector. Because of these interest rates going higher, that would benefit the banks. And dare I say Bitcoin? I mean, famous portfolio manager Paul Tudor Jones says around 5% Bitcoin allocation makes some sense with all the inflation going on. Also, I don't know if anyone's noticed higher prices when it comes to gas, but crude oil has been pumping up year to date, and it's currently at $72 per barrel when it comes to the crude oil July futures. And one way I'm personally playing into this is through VDE, which is an index ETF, which has a majority of its holdings in companies like ExxonMobil and Chevron, which should do well with crude oil being much higher. And not just crude oil, I think across the board when it comes to commodities would do well when it comes to inflation. It's just for me, I don't normally play these through direct futures. I'll play them through companies that are producers of these commodities that would benefit from an increase in prices. So for instance, you have companies like Nucor, which is one of my favorite steel plays, but I did trim this because of my concerns around expected growth is already starting to be built into some of these stocks. While I do mention Nucor might have a little growth expectation in it, I don't think these prices of $16.58 per ton are sustainable. I think the supply side will fix this because these companies that are in the commodity business, when prices are this good, they're going to increase supply. Eventually, they're going to create too much, which will drive down the price, which could affect the stock. For me, this is where you have to decide whether or not you think the inflation or the increase in prices is inflationary or partly due to the supply issue. I think a bigger chunk of it is probably the supply issue with the economy opening up and just not enough steel being out there with the demand being increased for the opening of the economy. Honestly speaking, I don't think this Fed meeting really added too much new information. I mean, we're talking about rate hikes there in 2023, which is pretty far out. Also the fact that Jerome Powell keeps on saying it's all dependent on data, so he's giving himself a way out. Also, if the information is coming in stronger than expected, then they can increase the rates. And for me, I think there's more money to be lost by fearing and panicking over a possible rate hike than just staying in the market, because it's one of those situations where a month from now, when we're at all-time highs, obviously I don't know that for sure. If we are, everyone's going to look back and be like, oh, that Fed meeting didn't really change anything. The bond purchasing is still going on. The rates are really low. Companies are growing their earnings, and inflation is high, but the hope is it is still transitory. Something else to consider is if you're an investor in growth stocks, this increase in yields and also the inflation fears would hurt your portfolio, because we saw the same thing happen in March when yields spiked to 1.7%. If yields continue to go higher and inflation does come through much, much higher, that's not a great story for growth stocks, because their future cash flows are being discounted at a higher rate, meaning that the future cash flows aren't worth as much in today's dollars. Anyway, that's my update on the Fed meeting. Also, nothing has changed too much from meeting to meeting. It really comes down to what the inflation expectations are, what unemployment is coming in at, and the talks around when the rate hikes are going to happen. Because the market is trying to feel out, hey, when is he actually going to raise the rates? And everyone's trying to beat each other to the punch, right? And get out before there's some taper tantrum. But I believe in the long term, inflation won't kill the market. So as long as there's not hyperinflation, I don't think anyone wants that. But yeah, in the long term, I think the markets will be fine, even with a little bit of inflation. If you did enjoy this video, give it a thumbs up and consider subscribing to Main Street Wolf, where we talk investing, talk stock options, anything to do with money. Thanks guys for watching, and have a great day.